Hello and welcome to Startup Street. I'm Shruti Mishra and joining me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup space. Amazon India to lay off 1% of its workforce, approximately 1,000 Amazon India employees to be impacted, sources tell CNBC-TV18. Layoffs to be across marketplace and devices teams. The tech giant is cutting 18,000 jobs across the globe.
Fintech platform Credit B raises another $100 million as part of its ongoing Series D funding round from Advent International, making it the first large primary funding round of 2023. The firm raised $80 million from existing investors in the month of December.
Dunzo is in talks to raise up to $100 million through convertible notes, says a report. The startup is primarily raising this capital to expand its quick commerce service, Dunzo Daily, the report added.
Hospitality giant Oyo writes to NCLT alleging that FHRAI members are fighting tooth and nail to intimidate and harass the hotel industry, urges action against erring executive committee members of the hospitality industry body.
TikTok freezes hiring process for consultants that would help it implement a potential security agreement with the United States. According to Reuters, TikTok has told consultants vying for roles late last month that the hiring process was on hold, adds that it will update on restarting hiring by the end of January.
Hackers steal the email addresses of more than 200 million Twitter users and post them on an online hacking forum. Alon Gal of Israeli cybersecurity monitoring firm Hudson Rock says the breach will unfortunately lead to a lot of hacking, targeted phishing and doxing.
ChatGPT creator OpenAI is in talks to sell existing shares in a tender offer that would value the company at about $29 billion, the Wall Street Journal reported. The deal would attract investment of at least $300 million in share sales.
EdTech unicorn Lead enters into an agreement with learning company Pearson to acquire its local K-12 learning business in India for an undisclosed sum. The acquisition is subject to customary closing conditions and is expected to be completed by the first quarter of calendar year 23. All right, so those were the headlines that we're tracking for you today on Startup Street. Now, the tech space, which witnessed a big wave of layoffs in the last few months of 2022, seems to have no respite in this new year. The year has begun on a grim note as global tech firms have announced more layoffs in the first 5 days of January than they did in the whole month of December. Now, according to layoffstracker.com, over 28,000 people were handed pink slips from the 1st to the 5th of January as compared to 17,000 layoffs in the month of December. Now, Amazon and Salesforce are among companies that have announced layoffs this month. Shilpa Ranipeta is here with us with a roundup of this bad news. Shilpa, how bad exactly does it look at this point?
As part of Amazon's ongoing layoffs, sources tell us that roughly 1,000 employees, or 1% of Amazon's India workforce, will be impacted. And this will be largely from the devices, marketplace and HR teams. Now remember, this comes after Amazon CEO Andy Jassy said that Amazon is letting go a little over 18,000 jobs, admitting that the 2022 review has been more difficult given the uncertain economy, especially with the company hiring rapidly over the last several years. Now remember, this also comes after Amazon India recently shut down its EdTech and food delivery segment as well, among others. And Amazon isn't the only one in 2023. Earlier this week, Salesforce also said that it is letting go 10% of its workforce. That's more than 7,000 employees, and it's also closing some of the offices amidst a challenging environment, customers rethinking purchasing decisions, and again, overhiring. Now, in addition, media company Vimeo too is laying off about 11% of its workforce, and this after it already cut jobs in July last year. Now, reports also suggest that TikTok's parent ByteDance is also handing out pink slips to employees across departments. Now, these companies join a big list of big techs that like Meta, HP, Twitter, Cisco, among the others that had laid off thousands of workers, the biggest impact being in the last 2 months of 2022 in December and in November, where over 88,000 tech employees lost their jobs globally. And if the first 6 days of January is any indication, the pain will continue well into 2023 as well.
Well, Shilpa, the year has definitely started on a grim note, but moving on, consumers would rather wait for their grocery than pay delivery fee for it. This according to a survey conducted by local circles. The study also indicates that quick commerce startups might not be able to sustain unless they are willing to offer discounts and differentiation. To elaborate on the report's key findings, joining me now is Sachin Taparia, the co-founder and CEO of Local Circles. Sachin, welcome to Startup Street. Now, the survey indicates that while value, quality of products and service matters, timeline of deliveries do not matter as much. Now, according to your report, only 3% of household consumers are willing to pay delivery fees and get groceries delivered within 30 minutes. Is this, this again, Sachin, raises the debate about the long-term viability of quick grocery platforms that promise delivery at doorstep within 10 to 30 minutes. Is there a real market for them?
Very much so, Shruti. I think what we are finding is value, quality, and service are the top three parameters that people have in mind when shopping for groceries online. And let us also understand that the entire, fast delivery phenomena is, till date, largely a metro phenomena, top cities. You don't have, these delivery services in Kanpur and Bhopal and Madurai and smaller cities yet. And hence, if you look at the entire, country, essentially, people are willing to wait to get their groceries. What that does is it puts a question mark on these delivery services and fast grocery services.
Yes.
To the extent that, can they really sustain and offer without any venture capital funding or without funding from their parent company, because many are now owned by large corporates.
Yes.
Can they actually sustain and provide the same discount that, let's say, somebody with very high scale can offer because of procurement efficiencies, right? So if that discount was not funded through external capital, then,
yes,
do they have enough scale
Sachin,
to be able to offer such a value proposition?
Yes, Sachin, picking up from what you just mentioned, in the survey, consumers identified that the highest levels of discounts were being given by platforms like JioMart and Flipkart, while they found relatively higher prices at Dunzo, Swiggy, Instamart and Zepto. So the study also indicates what you were mentioning, that unless quick commerce startups were willing to offer discounts and differentiation, they might not be able to sustain. So are discounts and offers the way forward for the sector? And does that mean it's difficult for the new platforms to compete with the big boys?
I would say so that, these discounts will continue. But at the same time, I think, quality and service is extremely important, where, if somebody orders fruits and vegetables, as groceries, they want, good quality produce that they can get in the local market, right? So people don't want to compromise on that. And at the same time, they want at least, market prices, basically. So what that does is, essentially, unless you have lots and lots of scale, across the country and in every city where you are offering these services, you will have to, be reliant on external capital to fund it until you achieve that scale. So while, discounts essentially are going to be important for consumers,
okay,
I think it's the combination of discounts and quality and value that matters to at least the majority.
Okay. The survey also indicates that the total addressable market for quick commerce players is small unless they are able to meet the price point, like you were mentioning, and raise additional capital from investors. The sector is looking at consolidation. What do you make of this, Sachin?
It absolutely is ready for consolidation,
okay,
largely because, you essentially need, you need these services for your incidentals, for your last minute purchases, right? But they need the procurement efficiencies of large corporations, right? So for instance, right, if a household is buying, a 6 kg pack of surf, which costs, which probably has a selling price from the manufacturer of 1,000 rupees and a 1,400 MRP, right? It typically sells for 11 or 1,200 at these large platforms,
okay,
right? So for any of these quick commerce platforms to be able to get into that, either you fund that discount or you find
Okay.
very large scale, or you find the procurement efficiency of a large corporate, right, that you can then use to get, very attractive prices and then serve the consumer.
Okay. One final question, Sachin, before I let you go. Let's talk about consumer ratings. As part of the findings, you also conducted a pilot in Noida between July to December last year to rate grocery delivery platforms on the basis of quality, value, service selection, and customer experience. What were your learnings and what did the ratings suggest?
Again, the ratings they basically suggest that for quality, people rate Amazon Fresh and Big Basket as the highest. For service, they rate Amazon Fresh as the highest. For value, it is Flipkart and JioMart, which seem to offer the highest amount of discounts. And selection is also very important to people, where they rate Big Basket and Amazon, some of the larger platforms, ahead of some of the faster delivery platforms. So, while fast delivery is good and a nice to have for people for their incidental purchases, they want, those three important parameters, which the large players today are offering, but the smaller ones are trying to, but it's going to be a long road for them to get there and be able to offer that.
All right, Sachin, we've completely ran out of time and it's time for us to wrap up this conversation. But many thanks for elaborating on the key highlights of your report. Again, thanks for joining us on Startup Street.
Most welcome.
Well, on the hot seat today, we have KEKA, which is an HR tech based out of Hyderabad, which recently secured $57 million of funding from Westbridge Capital. Now, this is the largest such Series A SaaS funding for a startup in the country. Now, the platform streamlines and automates payrolls, recruiting, as well as leave and attendance, among other functions. It works with over 6,500 customers in India and runs the payroll of 1.5 million employees monthly. So let me welcome Vijay Yalamanchili, the founder and CEO of KEKA, to tell us more about the company and the road ahead. Vijay, thanks very much for your time here on CNBC-TV18. Let me start by asking you, because we read about how KEKA was born out of your frustration from the existing systems which you wanted to simplify. 7 years later, you have more than 6,500 clients. Tell us a bit about the growth curve that you've seen and what you expect to achieve in this new year.
Sure. So it's been a long way since we came where we started like 6 years ago when we launched the product. But yet, with a new fundraise, I just feel like we're just getting started. So the growth for us, I think the first 1 year actually is what mattered most. We made sure that we are working closely with the customer, trying to solve what matters most for a customer that is specific to India market. That actually gave us a good amount of leverage in building a right product that helped us actually grow. And we've done a lot of things that are non-scalable. We worked with one customer to one customer, trying to get word of mouth and organic SEO. We have not spent any money on the marketing, but we still were able to grow 100% year on year consistently all through the journey. So that's been the journey. So 2023 is a big year for us because we believe that this space, there's so much to build, so much to disrupt and impact the customer. So we are doing a lot of initiatives in 2023, like connecting the SME in forums across the cities, being able to not just provide a platform, but forum where people can actually interact with, HR people can interact and have problems addressed.
Sure. Vijay, let me come back to that funding that you raised, because you were bootstrapped for quite a few years before you went ahead and raised this $57 million. What do you plan to do with it?
I think, we were able to raise that significant round because we were bootstrapped for a good amount of time and we were able to produce growth. In terms of being able to, we want to focus on building the product, improving the product for existing customers. There's so much to be built in terms of talent acquisition, performance management, talent management, upskilling, and other areas. So these are the areas we would like to invest on the product. And we're also looking to expand into other geographies. So that includes Southeast Asia and, other Western countries as well.
Actually, that was my next question. What are these expansion plans? Because I think I also remember in your other interviews where you mentioned US and European markets as other geographies that you were looking at. What's the update there?
Sure. So I think, India is growing, by the way. India market alone is growing tremendously, despite all the recession and slowdown conversation. I think Indian hiring is continuing to go well. So we see that we're able to do more than 100% growth within India. And within these other new geographies, because, HR, when it comes to HR, the software we build for India may not really work for these other countries. The focus is going to be building the right product for those markets, act like a startup we are in these new geographies, figure out the problems relevant to that job, and then work on scaling.
Okay, so when you're talking about scaling, how many potential new clients do you think you'd be adding in the near future? And how many of these will be from the overseas markets that you're targeting?
So I believe about 20% of our new revenue is going to come from the overseas market, because this is just the first year we're actually launching.
Okay.
But following year, in the next 5 years, right? So I see that overseas market going to be more than 60% of our growth. So that is a growth we are looking from the overseas market.
Okay, Vijay, and one final question. Since you're in the HR industry, we saw a lot of things happen, from the great resignation to the quiet quitting and whatnot. What are some of the new trends emerging that you've seen in the industry?
I think the emerging trend, first, employee right has been come to a limelight, right? So traditionally, customer has always been a king, right? But I think now for all the businesses, there's a queen, which I believe is employee. Now, if you serve your employee well, they'll serve your king well, right? The customers. I think that's a new realization that has come, and there's much more value given to employee as a notion. I think that's something that has come. From a HR tech perspective, there's more adoption of technology that's continuing to happen. COVID has brought that change. So these are the primary trends that I see. So I think the relevant employee and employee technology is much more in 2023 than it ever was.
All right, Vijay, on that note, thank you very much for your time here on CNBC-TV18. Thank you.
All right, thank you.
On that note, it's time for us to head into a short break. But coming up, we bring you a special report on how Dalchini Technologies is helping women become micro-entrepreneurs. On the other side, stay tuned.
Welcome back to Startup Street. Now, Dalchini Technologies, which provides instant, healthy, home-style food through IoT-enabled digital vending machines, is upskilling women to become micro-entrepreneurs. The Dukaan Tech startup, which is also led by a woman founder, has 150-plus franchisee partners, of which more than 30% are actually women. Now, as part of our Future Female Forward series, my colleague Aishwarya Anand brings you the story of Prerna Kalra-led Dalchini.
Whether you're a working professional or visiting a hospital or waiting for a friend at a metro station, when hunger strikes, the first thing you go looking for is a vending machine. While the innovation is old, when the pandemic hit, the old school vending machines were repurposed and diversified to become no-touch points for food distribution. And with the intervention of technology, they're becoming smarter too. One such startup that is giving the makeover to vending machines with its IoT-based solutions to make them more advanced and digital is Dalchini.
If I look 4-5 years back, right, India had nearly zero smart vending machines, while on the contrary, there were more than 2 million vending machines in US, right? China, Japan had one vending machine on every 30 people. That is where I saw a gap. When we started Dalchini, we wanted to build a technology-first product and take vending machines from few thousands to a vending machine at every 200 meters of habitable area.
Dalchini's IoT-enabled physical and digital vending machines do not have any human intervention. It is 100% cashless, app-based and contactless.
What we built, the first thing was that we just removed all the buttons. Our vending machines are absolutely zero buttons there. There is just a QR code you scan, and the entire experience for the consumer is just on your mobile phones only. On the consumer side, we have tried to create an e-commerce like experience. You open the app, you find the nearest smart store, you buy, and then you go and pick up instantly. On the partner side, what we have enabled to the retailer is one is the inventory management, the second is the day-to-day operations of their vending machine, the production. We also enable them to manage their workforce who's refilling. This also enabled us to create this as an offering for a lot of different services in the country, right? Post-pandemic, what we changed was that instead of just limiting ourselves to office spaces, today more than 40% of our vending machines are there in manufacturing facilities, in MSMEs, in factories where it's a round-the-clock operations. A lot of these factories did not allow the consumers to carry mobile phones inside, right? We enabled them with smart RFID tags. Pre-pandemic, we were restricted to about, say, 10,000 plus offices, that's it, right? But post-pandemic, it opened up for about 65,000 plus MSMEs with 100 plus workforce, right? We also launched smart vending machines for cabs and buses.
Dalchini's vending machines are kiosks in partnership with over 100 D2C brands such as Sleepy Owl, Slurp Farm, among others, offers a range of different products including cooked food, personal care and hygiene products, and even stationery items.
Cloud Kitchen's delivery boy in a day delivers about 20 orders, right, in general. But with our vending machines, one delivery boy is able to manage 5 to 10 vending machines, and every vending machine is doing about 100 orders. So this guy is actually delivering about 500 to 1,000 orders every single day. Today, most of our products, the cloud kitchens that are selling, right, through our platform, right, they are priced in between 29 rupees to 99 rupees.
Alongside enabling brands to sell their products through its smart vending solutions, Dalchini operates a franchisee model to allow people to generate income by setting up their own smart vending machines and building smart stores in their preferred locations.
98% of our vending machines and smart stores are owned by our franchisee partners. More than 30% of our franchisee partners today are women.
In September, the Dukan Tech startup had raised $4 million in its Series A round from Unicorn India Ventures and other investors. Dalchini has clocked Rs 15 crore in revenues in the first 2 quarters of 2022 and aims to hit Rs 50 crore in annual revenue run rate by March 2023.
India's vending machine market is expected to grow at a compound annual growth rate of 17.2% between 2022 to 2028, owing to the growth in the retail industry. With over 40,000 hospitals and more than 500,000 workplaces, among others, it still remains a severely untapped market. However, Dalchini is confident that it can change the landscape and has the potential to install vending machines in over 6 million locations across India. With camera person Balbir Singh, Aishwarya Anand for CNBC-TV18.
Well, vending machines get a phygital makeover courtesy Dalchini, which is aiming to hit 50 crore rupees in annual revenue run rate by March 2023. It's Friday and it's time to see how the startup space fared in terms of new deals this week. 12 deals took place valued at $12 million as per data from Venture Intelligence. Some notable deals include rural lender Sarvagram, who is set to raise $40 million from Temasek, TVS Capital and others. Insurance Deco has raised nearly $37 million from Goldman Sachs, while enterprise software from Sirion Labs also received $25 million from Brookfield. Rural commerce startup Wilcott raised $13 million in Series A funding round, while lender to low-cost private schools Varthana also bagged $7 million from Microvest. Overall, the startup world has seen over 151 deals this year so far, valued at nearly $151 million. With that, it's a wrap from both Ritu and I on this edition of Startup Street. More news and updates coming up on the other side.